It seems like right now the stock market is in kind of a controversial state where some analysts are saying that stocks will continue to trend down for the next 6 to 12 months and shed off another 20 or 30%. And then there's other analysts that are saying that growth will start to pick up again this year and will eventually go back into a bull market again. But regardless of what everyone else is saying, I wanted to talk about a few different stocks that I believe have potential upside for this year and that you should at least consider adding to your watch list. Warner Bros. Discovery, or WBD, took a major hit this year, diving down from about $28 per share all the way down to $9 per share, but has recently recovered to a current price of about $11.30. And as you probably know by now, Warner Bros. Is a media conglomerate that mainly provides content through movies, TV, and video games. Warner Bros. Also owns HBO Max, which is a streaming service comparable to Netflix and Disney's Hulu. Warner Bros. Revenue has increased year over year since 2017, and the trailing 12-month revenue is currently at $26 billion, which is about a 118% increase from the previous year. Its gross profit has also increased year over year and continues to stay cash flow positive, as its free cash flow has stayed relatively flat each year, which is, for the most part, good news. The 12-month stock price prediction for WBD is about $21 per share, meaning if it were to climb to that price from where it's at right now, that would yield about an 86% return and could potentially go even higher than that with an even bigger return. But that's of course assuming it does hit that price of $21 per share, and there's no guarantee that it'll actually hit that price in the first place. It's also trading below its fair value estimate of about $30 per share, which is always attractive to value investors who are planning on buying and holding for the medium to long term. So Warner Bros. Discovery, or WBD, might be something worth watching this year. You may or may not have heard of Quanta Services, or PWR. Quanta Services is an electric energy contracting company located in Houston, Texas, with one of the largest and most highly skilled workforces in the nation. PWR stock since 2020 has just completely turned on the jets and took off towards the moon, and as you can see here, it's returned about 100% per year since early 2020. And even in 2022, which was one of the worst years in the stock market since 2008, PWR still came out on top, returning roughly 27% for that year. PWR has a current market cap of about $20 billion, a PE ratio of 47.6, and pays a very small dividend of about 0.24% each year. And since Q4 of 2021, it hasn't missed earnings estimates, which is always a good sign too. PWR is currently rated a 1.8 on the analyst recommendation scale and has a 12-month price target of about $163. So both the total revenue and the gross profit have been increasing year over year, and the free cash flow for each year has not only been positive but still remains significantly high, which allows Quanta to continue to invest in and acquire entire companies in its sector. And if you notice, in the year 2020, Quanta had nearly $1 billion in free cash flow, which could be one of the reasons why its stock price has been performing incredibly well since 2020. So Quanta Services, or PWR, is another stock or investment to keep your eye on this year. Ulta Beauty is also another growth stock that outperformed the S&P 500 in 2022 by a long shot, getting about 22% for that year. Ulta Beauty is a retailer of beauty products in the United States with over 1,300 locations nationwide. Ulta Beauty has a market cap of about $25 billion, a PE ratio of around 21, and its one-year price target is about $517. So Ulta does have a pretty high share price of just under $500, but that doesn't always mean that it's necessarily overvalued. It's beat earnings estimates every single quarter since Q1 of 2022, and it's currently ranked at 2.2 on the analyst recommendation scale. Ulta continues to have increasing revenue year over year and has stayed cash flow positive for multiple years in a row. Some would even say that Ulta is a business that's pretty recession-proof because it's selling products that people are always going to be interested in and will continue to buy no matter what economic state that we're in. So although Ulta has grown significantly over the past 5 years now, and it's right around its all-time high, there is still a lot of room for growth in the coming years. I could always be wrong and things could always change, but based off of the research that I've done, these three stocks should have the potential to grow in the medium to long term. But let me know in the comments what you guys think, and I will catch you next time. See ya.